In October 1962, the world held its breath. Missiles in Cuba, warships at sea, leaders on the edge of nuclear war. But thousands of miles away, something else was happening, in silence. The price of gold in London rose above $35 an ounce. Not for long, just hours, sometimes minutes. But each time it did, phones rang in Basel, Zurich, and Washington. Because under the surface of a global crisis, a different war was playing out, not in Cuba, but in the markets. A war over trust, over money, over who controls value when the world begins to crack. Behind the scenes, central banks weren't watching missiles. They were watching gold. Because if gold rose too much, the dollar would fall. And if the dollar fell, the entire structure built after 1945, the Bretton Woods system, could collapse like wet cardboard. Pegged exchange rates, U.S. reserves, European recovery, all of it depended on one assumption, that the dollar was as good as gold, literally. But it wasn't. And by 1962, the cracks were spreading. This wasn't just geopolitical tension. It was a currency crisis hiding behind a military standoff, an invisible auction on the value of American power, measured not in weapons, but in gold ounces and trade deficits. And here's the twist. At the very moment when the public feared mushroom clouds, a hidden coalition of bankers and officials scrambled to contain something else, a quiet run on American credibility. Because while the world feared war, the markets feared inflation. And what does that mean? It means this. The Cuban Missile Crisis wasn't only a political drama, it was a financial pressure test. A silent referendum on whether the United States could still anchor the world economy, or whether that anchor had already begun to drift. Some knew, most didn't. But history leaves signals, and sometimes the loudest explosions are the ones no one hears. In 1962, the world ran on trust, but trust had a currency, and that currency was the US dollar. After World War II, 44 nations gathered at Bretton Woods and made a pact. Currencies would be pegged to the dollar, and the dollar would be pegged to gold. 1 ounce, exactly $35. Not more, not less. This wasn't a metaphor, it was a legal commitment. France, West Germany, Japan, and dozens of others didn't just believe in the dollar, they relied on it as a stand-in for gold itself. The dollar became the bloodstream of global trade. Oil, steel, wheat, all priced in green. But the U.S. didn't just hold power, it printed it. Through the 1950s, America financed Europe's reconstruction, military alliances, and multinational expansion. It ran deficits and sent dollars abroad. That export of capital rebuilt Western Europe, but it also created a paradox. The more dollars flowed overseas, the more foreign governments held them. But they could, at any time, redeem them for U.S. gold. The numbers began to diverge. In 1950, the U.S. held around $24 billion in gold. Foreign claims, only $9 billion. But by 1960, gold reserves were down to $18 billion, while claims had surged above $19 billion and rising fast. More dollars than gold, a classic mismatch. And yet, on paper, everything still worked. The dollar remained stable, European central banks played along, confidence held, until it didn't. Meanwhile, a new force was emerging, the eurodollar market, a shadow system of dollar-denominated accounts held outside the U.S., beyond the reach of American regulators. London banks lent these offshore dollars freely. They multiplied, quietly, exponentially. Money was now leaking into a parallel system, and with it, control. At the same time, geopolitical costs escalated. The U.S. was spending billions on NATO, propping up allies in Asia and underwriting the arms race. All of it required dollars. But those dollars, once spent abroad, became liabilities, claims on gold sitting in Fort Knox. This was the hidden engine of the crisis, because behind the Cold War headlines lay a more fragile reality. The global economy stood on a narrow shelf, the illusion that every dollar could be turned into gold, even though everyone knew it couldn't. What kept the illusion alive? Diplomacy, secrecy, intervention. In 1961, the U.S. and 7 European central banks formed the London Gold Pool, an agreement to coordinate sales of gold to stabilize its price, not for the public, but for the system itself. If gold rose above $35, they would intervene, quietly, forcefully, not to profit, but to defend the architecture. It was economic theater, but with real stakes. Because any sustained rise in gold would mean that the dollar was weakening, that inflation was rising, that trust was cracking. And trust is what held the post-war world together. By October 1962, the political confrontation in Cuba took center stage, but the economic confrontation between illusion and solvency had already begun. The missile crisis simply pulled the curtain tighter. Imagine the paradox. As Kennedy and Khrushchev exchanged threats, traders in Zurich and London were betting, not on war, but on gold. And they were right to. The real breaking point didn't arrive with tanks or ships. It came through arithmetic. By 1962, the United States had a visible gold reserve of around $16 billion. But foreign dollar claims were over $19 billion and growing. That meant if every foreign holder of dollars demanded gold at once, the U.S. couldn't pay. Not theoretically, mathematically. It was a silent countdown, ticking inside the system. And it wasn't just about numbers, it was about behavior. Because once markets suspect that redemptions can't be honored, they act faster. Not linearly, exponentially. This is how all currency systems crack. Not when the last dollar is printed, but when the first demand can't be met. That's why the gold pool existed. Its purpose was to stop that moment from arriving. Every time the market pushed gold above $35, the pool sold from its reserves to pull the price back down. It worked, until it didn't. In October 1962, while the world watched Cuba, London gold traders noticed something strange. A sudden increase in large volume, anonymous buy orders. Quiet, strategic, coordinated. Prices rose, just cents at first, then $1. The gold pool responded with sales, but volume overwhelmed supply. It wasn't a rush, it was a signal. Someone, somewhere, was testing the system. And now imagine, in the middle of the most dangerous nuclear standoff in history, U.S. financial officials were scrambling not only to avoid war, but to suppress a currency panic. Because if gold closed even one full day above $35, the illusion would break. That price wasn't just symbolic, it was structural. It anchored every currency in the West. A dollar collapse wasn't inflation, it was disintegration. And there was another problem, France. President Charles de Gaulle had long distrusted the dollar-centric system. He believed the U.S. had created a financial empire without accountability, using paper to buy real assets abroad. In his words, an exorbitant privilege. In early 1962, the Banque de France began converting its dollar reserves into gold, quietly but consistently. By summer, the French were flying U.S. gold across the Atlantic. This wasn't betrayal, it was math. They saw the same imbalance everyone else saw, but unlike others, they acted on it. Every shipment drained America's reserves, and every shipment was legal. That was the flaw in the design. The system allowed redemption, but couldn't survive too much of it. Then came the market reaction. As gold demand spiked, the U.S. Treasury began leaning harder on its partners. Pressure mounted on West Germany and the UK to recycle dollars rather than convert them. Behind closed doors, deals were made, quiet understandings, deferred claims, but markets aren't loyal. And in November 1962, just weeks after the missile standoff ended, the London gold price broke $35.20. It didn't last. The pool crushed it back down the next day, but the breach had occurred. From that point, intervention became constant. Defending the price required more coordination, more sales, more illusion. It was no longer stability, it was performance. And here lies the paradox. While the world believed the Cuban Missile Crisis ended with diplomacy, a deeper fracture remained unresolved. The gold dollar system had passed a point of no return. Trust had been shaken, and from that moment on, every calm day in the markets came at a cost. Stability now required constant manipulation. And manipulation creates dependence. Dependence, eventually, becomes collapse. To understand how the crisis quietly mutated into a monetary emergency, we need to step into the mechanism itself. Not ideology, not diplomacy, just flows. Gold didn't move because people lost faith in American democracy. It moved because of math, incentives, and timing. And at the center was a fragile promise that $1 US held abroad could always be converted into gold at $35 an ounce. That promise created what economists later called a built-in arbitrage. Here's how it worked. Foreign governments, banks, and exporters earned US dollars through trade, mostly from selling goods to America. Under Bretton Woods, they could either hold those dollars in reserve or convert them into gold. As long as the US had the reserves, that seemed fine. But by the early 1960s, some noticed a gap. The cost of holding dollars, especially during inflation, began to outweigh the benefit. If gold's real value was rising, but the official conversion rate stayed fixed, then each dollar was quietly losing purchasing power. So a rational actor, say the Banque de France, could simply exchange dollars for gold at the fixed rate, then wait, or sell on private markets where gold was already trading above $35. This wasn't speculation, it was logic. And markets noticed. Private investors in Zurich, Frankfurt, and London started moving in parallel. They couldn't access US gold directly, but they could buy from intermediaries who could. The volume was small at first, but grew with every breach of the $35 line. That's where the London Gold Pool came in. Formed in 1961, it was a cartel of 8 central banks: the US, UK, West Germany, France, Italy, Belgium, the Netherlands, and Switzerland. Their goal? To defend the $35 price, not on moral grounds, but systemic ones. Each central bank contributed a fixed quota of gold. When market demand pushed the price above $35.20, they would sell from this shared pool to suppress the price. When demand waned, they could buy it back. Supply and demand? Not here. This was price fixing, coordinated, concealed, and essential. The system functioned like a circuit breaker, but it had a cost. Every sale drained physical gold out of central bank vaults, and every dollar used to buy it back was a dollar that could have served other purposes: foreign aid, defense budgets, infrastructure. Now layer this with geopolitical stress. The US was running twin deficits, fiscal and trade. It was spending more than it earned and importing more than it exported. Normally, this would weaken a currency, but under Bretton Woods, the dollar couldn't fall. So pressure accumulated elsewhere, in gold markets, in swap lines, in secret meetings. To buy time, the US and allies invented tools. One was the gold cover, a legal requirement that every US dollar in circulation had to be backed by 25% in gold. In theory, this kept issuance in check. But as deficits ballooned, the cover ratio dropped dangerously close to the minimum. Another tool, currency swaps. If a foreign central bank wanted to redeem dollars for gold, the US Treasury would offer a temporary currency swap instead, dollars for francs or marks or pounds. The aim was to delay redemptions and keep gold in the vault. It worked until trust declined. Because when a system depends on delay, delay becomes default. By late 1962, everyone inside the system knew what the spreadsheets were saying. Foreign claims exceeded US gold. Private gold demand was rising. Political pressure in Europe was mounting. And yet, on the surface, the price stayed at $35. It looked stable, but it wasn't equilibrium. It was maintenance. Every day of calm required fresh intervention. Gold was no longer a mirror of confidence. It was a controlled stage. The show could go on as long as no one walked backstage. And this is the insight. The Cuban Missile Crisis didn't break the financial system. It revealed that it was already broken. The missile standoff served as a cover, a distraction, even a justification for tighter controls. But what had begun as a global pact for stability had become a hidden struggle to delay the reckoning. If you now see how systems survive not by truth but by timing, let me know where you're watching from. Once a system depends on illusion, every correction becomes a threat. By 1963, the gold pool was operating under constant stress. What had been a contingency became routine. Sales outpaced purchases. Rebuilding reserves took longer. London, the heart of the operation, saw weekly waves of gold outflows. Traders no longer believed in the $35 price. They simply timed their bets around interventions. The central banks tried to hold the line. But holding a line requires coordination, and coordination requires shared interests. That began to fracture. France, already skeptical, withdrew from the gold pool in 1967. The Banque de France resumed full conversion of dollars into gold, not through negotiation, but by force of contract. De Gaulle wanted to restore a gold-based standard, not just symbolically, but physically. He demanded delivery, and got it. French naval ships crossed the Atlantic to collect bullion from the New York Fed. No headlines, no broadcast, but the message was clear: the game was ending. One by one, smaller European banks began doing the same. Quiet redemptions, fewer swap rollovers, increasing tension in monthly meetings. The United States tried to project confidence, but behind closed doors, internal memoranda at the Treasury and the Federal Reserve spoke bluntly. The cover ratio was dangerously low. Gold outflows were unsustainable, and domestic political pressure to close the gold window, ending dollar convertibility, was rising. The invisible mechanism had become a liability. In 1968, the London gold pool collapsed. It didn't implode in a single event. It disintegrated in a sequence: March panic, emergency meetings, and finally, the decision to close the London market for several days, an unprecedented move in peacetime. When it reopened, it was split in two: an official gold market, still $35 an ounce, and a free market, where gold floated freely. Two prices for the same metal, one legal, one real. The consequences were immediate. The two-tiered system exposed the failure. Central banks could no longer pretend to anchor gold at $35, while private markets traded at $38, $40, or higher. The dollar's credibility split along the same fault line. Foreign central banks began accumulating gold on the open market. Confidence in the dollar slipped. The French, the Swiss, even the Germans hedged, not against U.S. politics, but against U.S. math. By 1971, the system broke. President Nixon, faced with a tidal wave of gold demands, ended dollar convertibility altogether. The dollar was no longer as good as gold. It was just paper, backed by faith alone. This wasn't a reform. It was a default. The world moved from a gold-anchored order to a floating currency regime, unannounced, unplanned, and irreversible. The Bretton Woods system, crafted in 1944, died in silence. And who paid the price? Emerging markets, whose reserves evaporated in devaluation. Exporters, whose dollar revenues bought less and less. Ordinary citizens who watched inflation rise through the 1970s without understanding its source. The U.S., freed from the gold constraint, printed more. The dollar became a global liability, accepted everywhere but trusted nowhere in the same way again. This wasn't collapse, it was transition, but one built on a vacuum. And the lesson? A system can persist long after its logic fails, as long as its symbols hold. But when the symbols split from substance, reality returns all at once. Today, there is no gold window. No central bank promises you can trade your dollars for metal. No vault anchors your savings. And yet, confidence holds. But why? Because the system learned a trick. It replaced convertibility with liquidity. The promise is no longer, you can exchange your dollar for gold, but you will never need to. In 1962, gold was the pressure valve. Today, it's the central bank. The Federal Reserve doesn't defend a fixed price. It manages expectations. It doesn't limit the supply of money. It manages the supply of trust. The system changed names, but not logic. Take quantitative easing. At its core, it's a mirror of the gold pool, a coordinated intervention to suppress signals of instability. In the 1960s, that signal was the rising gold price. In the 2010s, it was the bond yield. Then it was, the dollar must stay pegged to gold. Now it's, interest rates must stay near zero. Both are mechanisms to prevent revaluation, to delay repricing, to maintain the illusion of control. Consider the response to the 2008 financial crisis. Massive liquidity injections, asset purchases, swap lines between central banks. These are not innovations, they are echoes. In 1962, the U.S. leaned on its allies to suppress gold. In 2009, it leaned on the G7 to suppress panic. But the underlying vulnerability is the same. In both systems, money expands faster than its anchor. Then, the anchor was gold. Today, it's productivity, real output, the goods and services that give currency meaning. And again, the mismatch grows. Debt piles up, deficits deepen. Markets rely on forward guidance like they once relied on a fixed rate. The language is more technical, but the fragility is just as real and just as silent. During the pandemic, global central banks added over $11 trillion to the system in under 2 years. That's not policy. That's emergency monetization. But the public didn't see crisis. It saw stimulus. The consequences, inflation, asset bubbles, structural imbalances, came later, disguised as recovery. This is the same pattern. In 1962, the missile crisis drew public fear, while gold markets showed the real pressure. In 2020, a health crisis masked a financial one. Markets didn't collapse because central banks became the new gold pool. The difference? Today, there's no ceiling, no $35 to defend, no anchor to lose because it's already gone. And yet, the system depends on belief, the belief that central banks are in control, that the dollar is backed not by gold, but by policy, by confidence. But confidence, once shaken, doesn't decline slowly. It breaks. That's the danger of fiat systems with no hard limits. Everything works until it doesn't. Everything seems calm until the velocity changes. And just like in 1962, the signals are there. Rising demand for gold, currency hedging, sovereigns diversifying reserves, not with paper, but with metal. Quiet shifts in allocation. Unofficial but unmistakable. In 1962, gold was a canary in the coal mine. Today, it still is, because systems change names, but physics doesn't. And the most dangerous assumption a society can make is that this time, the structure will hold. There was no explosion when the gold dollar system died. No ceremony, no funeral, just silence, and then something else, a floating currency regime. A new logic, a digital abstraction. But beneath it, the same current still flows. Value must be anchored, if not by metal, then by meaning, if not by promise, then by force. That's what the Cuban Missile Crisis revealed without saying it. The system wasn't threatened by bombs, it was exposed by numbers, by imbalances no one could admit publicly, but everyone had already calculated privately. And today, the gold window is closed, but windows still exist in policy meetings, in balance sheets, in coordinated statements from global banks, each one designed to do what the $35 peg once did, suspend gravity, buy time. But time is not capital, and delay is not resolution. History didn't end in 1962. It reorganized. Every system, monetary, political, strategic, carries its own contradiction, waiting to surface. And when it does, it won't begin with panic. It will begin, again, with math. Because history doesn't repeat. It waits for us to believe again.